Kristine, is all these deals are happening, and why is it that they're happening now? It's probably because, of the fear that interest rates and the cost to orchestrate these deals may rise as we go forward.
And hey, I mean, look at what happened today. I mean, the bump in the interest rates, like, it was not huge, but I think a lot of these deals were orchestrated at a pretty smart time.
Yeah, it's huge in that it marks the first major policy shift in almost a decade, as far
Oh
as
yeah, it's a
heading
strong
toward.
signal for sure.
It's a big signal. It's not. You're right. 25 basis points isn't a tremendous increase, but the guidance they issued today is something that people have to pay attention to. And that guidance is that all things equal, subject to change, all the caveats that the Fed typically says. You could get a percentage worth of increases over the course of the next 12 months. Well, when you're talking about billion-dollar deals, that percent can add up.
It definitely could. You're right. Should we be worried as investors about all this leverage?
Well, it really comes down to, I mean, leverage is bad if, we talked last week a lot about balance sheets and ways to analyze leverage. Debt is bad if cash flow doesn't exist. If you're taking on debt and that debt is translating into an investment that yields a lot of cash flow, and you can finance that, finance that debt through that cash flow, then it's fine. Typically speaking, though, you want to make sure that you're sticking with companies that have debt to equity ratios that are less than 100%. Lower is better where possible. And you want to focus on companies that the short-term, assets outweigh the short-term liabilities, so that you don't have to worry about insolvency within a given year. Overall, though, I'm not overly concerned about the how much leverage they're taking on. You got to take it stock by stock.